Trade policy shifts like new U.S. tariffs are disrupting borrowing in sectors like construction, logistics, and manufacturing, slowing deliveries and tightening cash flow. Joining us to unpack the impact are Brian Tay from Landella and Dr. Amitendo Palit from NUS ISAS. Now, starting with Brian, which sectors are seeing the biggest borrowing shifts due to trade friction?
Yeah, trade friction is changing how Singapore firms borrow, but not all sectors are reacting the same way. The most trade exposed parts of the economy, like manufacturing, wholesale trade, transport, logistics, construction, and even retail and F&B, they are behaving more defensively. These sectors are moving away from big multi-year loans towards short tenure, smaller working capital solutions to stay liquid. For example, in manufacturing, producers are cutting back on capex borrowing, focusing on working capital loans, while ICT hardware and medical equipment are financing inventory to capture strong regional demand. And our data at Landella backs this up, where we're seeing more demand for smaller loans and fewer for big ones. So what this means for business owners is that they're thinking survival, flexibility, optionality, and focusing on really that survival, right? And keeping their leverage light until trade conditions become clearer.
The larger impact appears to have been generally muted as far as direction of trade finance and borrowing is concerned. And that's primarily because on the exporters side, there is not a very high demand for shifting of finances as of now, because most businesses are trying to adjust to the new realities and the new tariffs. We have seen these tariffs getting implemented only from the last month. And the numbers that are coming out from the US economy right now are not very promising. So perhaps those numbers, along with the fact that the US Fed has also announced a short rate cut, might have given this hope to many investors, particularly from Asia and also exporters, that the United States might be wanting to take a closer look at the tariffs and their impacts. Till that happens, I think the supply chain managers and the businesses are going to hold their bets. But on the other hand, the greater global trade might not get very badly affected because all countries are looking to diversify. And there are countries from Asia, beginning from China downward, who are looking at other markets outside of the United States as important markets with whom they can expand their exports. And if those trade links pick up, then one can expect the volume of global trade not to have come down very significantly, and the demand for trade finance would be remaining by and large intact in that case.
But how have recent tariffs disrupted borrowing and affected industries?
Yeah, for an SME, such tariffs means paying more upfront while waiting longer to get paid, and this causes a painful squeeze on cash flow, right? A recent SBF poll published recently in April 2025 showed that over 80% of firms expect tariffs to hurt them, right? And nearly 60% are expecting higher working capital needs. So this is showing up in the enterprise financing scheme mix, where we're seeing 63% of applications being working capital loans, 33% trade loans, and just 17% project loans. So businesses are really in survival mode and are borrowing to bridge gaps and not reinvest to build empires. Borrowing is now smaller, it's shorter, and more operational, with lenders responding to tariffs by shortening loan tenures and raising collateral requirements as well.
Look at the markets at large. The markets have really reacted very adversely even after the tariffs have kicked in August. And I think by and large in Asia, again, very specifically, most exporters have been prepared for these tariffs, and they have been able to mobilize their working capital up ahead in anticipation of the new tariffs that are going to come in. But what will be a matter of uncertainty is that what is going to happen over the next 2 to 3 months? Are these tariffs going to remain stable? Are they going to be withdrawn following the American Supreme Court's view, or is the United States going to come out with further new policies on tariffs? I think till that time, and we are probably looking at a period which is up to the end of the year, so the last quarter of the calendar year. Till that time, I don't think that there will be very significant borrowing shifts that we are getting to see as far as demand for trade finance is concerned. What will happen thereafter is, of course, a different subject.
Now let's talk about project timelines and cash flow. How are customs delays affecting these?
So, when shipments are delayed by a month, incoming payments are also delayed a month. But guess what? Paying for salaries, paying for rent, these things can't wait. In fact, we're seeing firms that are already feeling that cash flow hit. And this is caused by the delay of orders, resulting in capex delays, or tapping credit lines to bridge the gap. So, as an ex-SME operator, I used to run boutique fitness studios in Singapore. I know firsthand how delays in equipment and construction can cause a delay in opening, cause a delay in operations, which in turn leads to a lot of cash stress. The encouraging sign is that we see at Lendela is that SMEs are becoming more disciplined. We're seeing more use of purpose-built tools like working capital loans, trade financing, bridging loans, and fewer personal loan applications for business purposes. And that shift shows that SMEs are maturing in how they manage cash flow.
One immediate impact of this is that they can't really hold on to their products, shipments at a very fluid level. They need to hold on to their products to their warehouses for a somewhat longer period of time because they are not totally sure about how much time the customs delays and inspections are going to produce in. So to that extent, the warehousing charges of exporters are going to increase, number one. Number two, there's another cost that has come in for exporters. That is, when it comes to invoicing of their products for the United States market, they are now having to go through a much larger volume of paperwork. So which means on their side, the official executive time devoted to these paperworks have gone up, and perhaps they have had to hire experts, customs experts, logistics experts, freight forwarding agents who are experts in the new system of invoicing to prepare this for them. All in all, these are costs that have started kicking in, and these are costs which the exporters might have to absorb as fixed costs as they go forward. I think the exporters will have to brace for a completely new system of alignment with customs rules and customs procedure. All in all, the bottom line of all this is that the cost of trade between various countries and the United States is going to go up significantly. And given that the United States accounts for roughly 12% of global trade, this is something which is going to come in as an additional burden as far as global trade costs are concerned.
Thank you so much for joining us today and for sharing your insights, Brian and Dr. Amitendu.
Thank you.
My pleasure. Thank you for inviting me to this conversation.
Once again, those were Brian Tay, Country Manager for Singapore at Lendela, and Dr. Amitendu Palit, Senior Research Fellow and Lead for Trade and Economics at NUS Institute of South Asian Studies. For more news, visit sbr.com.sg.